Hi, I'm Jim Stice. I'm a professor of accounting at Brigham Young University. This is my brother Kay.
I am also a professor of accounting at Brigham Young University.
We've been teaching accounting for a combined total of over 70 years.
In this course, we'll introduce you to the bookkeeping process that underlies the production of a company's accounting data. Now, these accounting data are ultimately used both within a company to make operating decisions and outside of companies to make investing and lending decisions.
You're going to learn about the famous debit and credit system.
You're going to see how the simple procedures of transaction analysis, journal entries, and posting can organize the data that come into businesses every day, from small businesses operated by individual entrepreneurs to huge multinational businesses with operations around the world.
Consider the information needs of a company such as McDonald's, launched by Ray Kroc back in 1954.
Now, the essence of McDonald's business seems simple. Revenues come from selling Big Macs, Happy Meals, Chicken McNuggets, and the like.
Operating costs include the cost of the raw materials to produce the food items, labor costs, building rentals, income taxes, and so forth.
But the magnitude of McDonald's operation makes compiling reliable information a challenge. Now, think in terms of volume, with system-wide sales averaging almost $300 million a day, and geography with locations in 120 countries throughout the world.
So, how are these millions of customers and supplier transactions summarized and eventually reported as useful information in the financial statements?
Well, this transformation process is called the accounting cycle. That's the bookkeeping part of accounting.
Now, you may have heard of debits and credits and journal entries and trial balances. Well, in this course, we're going to take the mystery out of these and other terms.
We will show you how transactions turn into financial statements. We'll show you how accounting systems are designed to aggregate mountains of financial information and turn that information into something that can be used by decision makers.
Now, don't be nervous. We've designed this bookkeeping course to be self-contained, and we carefully explain any terminology that we use.
In short, this is an introductory course with no prior accounting knowledge necessary.
So, you ready to go? Let's get started. For both of us, accounting has been at the center of our professional development for over 35 years. I enjoy the process of analyzing the financial statements of companies.
I enjoy knowing how those financial statements are produced, as well as their strengths and their limitations.
I have also enjoyed teaching accounting for these many years. I continue to be disappointed when I see that not everyone shares my fondness for the intricacies of accounting.
There's even people in our own family.
I know, even people in our own family. Now, people say that accountants speak a foreign language.
People accuse us of using top secret code words such as debits and credits, balance sheets, accrual, closing.
Well, we're here to tell you that those words aren't top secret. Those words aren't in a secret code. Instead, those words are associated with a language, accounting, which is commonly called the language of business.
And as the case with learning any new language, there's a learning curve. But if you're willing to put in the time, you can become fluent in those top secret code words. Before you know it, you can be speaking accounting.
Now, in this course, we'll cover the mechanics of accounting, commonly called bookkeeping.
Bookkeeping is the routine, systematic method of accumulating financial information, analyzing that information, inputting it into an accounting system, and then summarizing the resulting information into reports that can be used by decision makers.
We will learn about an ingenious system that was developed over 500 years ago and is still in use today.
We will learn about the mystery terms debits and credits, and we'll see how debits and credits are just shorthand for accounts increasing or decreasing in value.
We will learn about journal entries, T accounts, ledgers, and trial balances. Before you know it, you will become comfortable with these terms, what they mean, and how they are used.
Now, that's not to say that this course is going to be a stroll through the park. Just as learning any new language requires some diligence, so it is with the language of accounting. But hang in there, you can do it.
Now, before taking this course, we would encourage you to have a look at our course, Accounting Fundamentals.
That course provides an overview of the field of accounting and helps you see where bookkeeping fits in the grand scheme of accounting things.
With that said, this bookkeeping course is designed to be self-contained, but the Accounting Fundamentals course provides some helpful context.
So are you ready?
Are you excited to learn a new language?
Are you ready for the challenge?
Well, ready or not, here we go. Suppose you were asked how much to the nearest dollar you spent on food last year. To answer this question would require that you gather information like receipts, credit card statements, and canceled checks for all your expenditures, analyze that information to determine which outflows related to food, and summarize those outflows into one number, the cost of your food expenditures for the year. Now, once you've answered that question, answer this one. How much did you spend on clothes last year? Again, you would have to go through the same process of collecting data, analyzing the information to identify those expenditures related to clothing, and then summarizing those expenditures into one number. Without a method for gathering and organizing day-to-day financial data, answers to seemingly routine questions like these can get quite complex. Now you may be thinking, doesn't my detailed electronic bank statement allow me to easily answer these questions? Well, your bank statement would certainly help, but it's limited in that it tracks only the transactions that go through your bank account, like checks you write or debit card payments. It does not track the cash in your pocket, savings account, or other investment accounts. These payments are also not categorized by purpose, and the totals are not summarized. Now, consider the dilemma for businesses. They typically have far more transactions than you, and the kinds of transactions are much more varied. Businesses buy and sell goods or services, borrow and invest money, pay wages to employees, purchase land, buildings, and equipment, distribute earnings to owners, and pay taxes to the government. These activities are referred to as exchange transactions because the entity is actually trading or exchanging one thing for another. A bookstore, for example, exchanges books for cash. Business documents such as a sales invoice, a purchase order, or a check stub are often used to confirm that a transaction has occurred, to establish the amounts to be recorded, and to facilitate the analysis of the business event. To determine how well an entity is managing its resources, the results of transactions must be analyzed. The accounting cycle makes the analysis possible by recording and summarizing an entity's transactions and preparing reports that present the summary results. A transaction kicks off the accounting cycle. A transaction is when a business exchanges something and gets something in return. The value exchange needs to be quantified and recorded. Once all the transactions for a period have been recorded, those transactions must then be summarized. Once the day-to-day transactions are summarized, then financial reports can be created. Does this sound complicated? Well, it would be without a system to capture that information. But there's no need for us to invent the accounting wheel. That wheel was codified over 500 years ago and is still used by virtually all businesses around the world to capture and compile financial information. Large multinational corporations have millions of business transactions each day, and the more detailed and complex the accounting system, the more likely it is to be automated. Even small businesses generally use some type of inexpensive accounting software to reduce the number of routine clerical functions and to improve the accuracy and timeliness of their accounting records. Now, regardless of whether an automated or manual system is used, the steps in the process are basically the same. A transaction occurs. The transaction is then analyzed, journalized, and recorded to the accounts, and then summarized and reported and used for evaluation purposes. The difference lies in who or what does the work. With a computer-based system, the software transforms the recorded data, summarizes the data into categories, and prepares the financial statements and other reports. Nevertheless, human judgment is still essential in analyzing and recording transactions, especially those of a non-routine nature. We've designed this bookkeeping course to be self-contained, and we carefully explain any terminology that we use. This is an introductory course with no prior accounting knowledge necessary. With that said, though, the advice provided in this course is general advice only. It has been prepared without taking into account your objectives, your financial situation, or your risk tolerance. The course is not intended to give investment advice, but instead to communicate basic information to help viewers understand the basics of the topic presented. For investment advice, you should seek advice from your own trusted independent financial advisor.
Let's talk a little about financial statements. These reports provide some of the raw data people use in making financial decisions.
The first primary financial statement is the balance sheet. A balance sheet is a list of a company's valuable resources, its assets.
A balance sheet also shows the three general sources that companies use to get money to buy assets. First, they can borrow. Second, the owners can take money from their private savings and invest it in the business. And third, the company can generate profits that are then kept in the business to buy more assets.
The second primary financial statement is the income statement. An income statement is a report telling how much money a company made during the month or the quarter or the year, whatever period is covered by the income statement.
It seems like people are always talking about companies' income statement.
Yeah, you often hear in the business news about a company's net income.
Now, the third primary financial statement is the statement of cash flows.
So let me give you a lesson in accounting terminology. When in doubt, say it slowly. So what is a statement of cash flows? It's a statement of a company's cash flows.
So just a report of cash in, cash out?
That's pretty much it.
Okay, so there are three financial statements: the balance sheet, the income statement, and the statement of cash flows.
But those financial statements don't just create themselves. They are a culmination, the pinnacle, the capstone of the bookkeeping process.
So before we get into the details of bookkeeping, let's get an idea of where we're going. Let's look at the end result, the financial statements.
Now, back to those three primary financial statements. Which one is your favorite?
Oh, that's a tough question. I'll have to think about that.
Now, before we get into the complexities of analyzing transactions and such, let's step back and look at what this analyzing of transactions eventually results in, the financial statements. One of the major results of bookkeeping is to provide information with which individuals can make decisions. Financial statements are a means whereby the effects of lots of transactions are summarized and reported in a manner that is useful to users of financial statements. The three most common financial statements are the balance sheet, the income statement, and the statement of cash flows. Now, let's take a look at each of these in turn. Now, we'll start with the mother of all financial statements, the balance sheet. The balance sheet is called the fundamental financial statement. It contains a listing of a company's assets, its resources, its valuable things like cash, inventory, land, those things that it holds to sell. Those are its assets. The other part of the balance sheet is a listing of where the company got the money to buy those assets, liabilities, and equities. The balance sheet embodies the accounting equation, one of the greatest inventions of the human mind, invented in Italy over 500 years ago. A list of things we own, assets, that's easy. Anybody can list assets. But the insight from the accounting equation is to then list also where did we get the money to buy those assets, the liabilities and the equities. Now, assets, they're our valuable resources. They are items that will provide us benefit in the future. Cash, for example, is an asset that we can all quickly identify. If you look at the balance sheet of Apple, for example, you see that Apple had on September 29, 2018, $25.9 billion in cash. Now, that's a lot of money, but it's not even close to being Apple's biggest asset. Another asset is accounts receivable, money that is owed by other people to a company. That's another common asset. Continuing the Apple example, at the end of September 2018, customers owed Apple over $23 billion. Apple also had inventory, all those iPads, iPods, iMacs, and iPhones. At the end of September 2018, that totaled almost $4 billion. Property, plant, and equipment, or PP&E, all of those are resources that a company uses to accomplish its objectives. Apple had over $41 billion in property, plant, and equipment. But Apple's biggest asset was its marketable securities, the stocks and bonds of other companies that they have purchased. At the end of September 2018, Apple owned over $211 billion in the securities of other companies. Now that is a big asset. The second primary financial statement is the income statement. That's revenues minus expenses equal net income. We use the term revenues and expenses all the time, so let's make sure that we know what these words mean. In an accounting context, revenue means the amount of assets generated in doing business, and different companies generate assets in different ways. Walmart, for example, generates assets by putting things on shelves that you and I buy. That's how Walmart creates assets. Microsoft creates assets by creating software and hardware that you and I then buy, and we pay Microsoft for those things. Disney has consumer products. They have cruises. They have theme parks. We pay to use those things or to buy those products, and that's how Disney generates assets. Revenue is the amount of assets generated in doing business, and hopefully the assets generated are less than the assets consumed. Expenses are the amount of assets consumed in doing business. For example, Microsoft consumes assets by paying programmers and by paying for equipment. Walmart consumes assets by buying the inventory that they then sell to you and me and by paying rent, by depreciating buildings, and by paying its employees. McDonald's consumes resources by buying food, buying paper, and by renting facilities. In each case, the revenues are hopefully more than the expenses that are consumed. All of this is put together in the income statement, a listing of a company's revenues less a listing of the company's expenses. That equals net income. Now, net income is a very sophisticated economic measure. It's the net amount of assets generated by a business through its business operations. This is the income statement. Now, let's look at some income statement examples for companies of which you've heard: Facebook, Google, Microsoft, and Apple. All of these companies have income statements that they have to release to the public on a regular basis. Now, take a look at these. First of all, you will see a difference in scale. Apple is so much larger than Facebook. In fact, Facebook is the smallest company on this list in terms of revenues, yet we talk about Facebook so much. This illustrates an important point. The financial statements are only one measure of a company's performance, a very important measure, but only one measure. So why do we talk about Facebook so often? Because for Facebook, its operations now are only a small fraction of what we think they're going to be in the future. Facebook is expected to grow substantially in the future, so we talk a lot about them now. Now, each of these companies, Facebook, Google, Microsoft, and Apple, reported a net income for their most recent fiscal year. That is, their revenues exceeded their expenses by quite a large amount. These four companies are quite successful at using their assets to generate revenues. The point with the income statement is this: a company increases its net assets through profitable operations. You can see that each of these four companies has been very profitable. As a result, their net assets, they increase year after year.
At its heart, bookkeeping is about collecting information, getting things recorded. Because once events are recorded, then we can organize those events and start making things better.
For example, Walmart has 10 billion customer visits per year. In order to operate, Walmart must have an organized bookkeeping system in place to keep track of what those customers bought, how much they paid, what items need to be ordered, and so forth. 10 billion visits per year. Walmart needs a good bookkeeping system.
Google is the most visited website on the internet. There are between 1 trillion and 2 trillion Google searches per year. Now, how does Google make money? Well, Google makes money by charging advertisers for customer views or customer clicks. Now, how can the company charge those advertisers unless Google has a system in place of keeping track of the number of clicks and what people clicked on? Now, the Google search engine is awesome. The Google bookkeeping system is equally as awesome.
Without bookkeeping, Walmart and Google could not continue to function. Bookkeeping seems mundane, but that's where it all begins.
Now, let's make this more personal. Think about you and your personal budget. In fact, let's focus on your food budget. How much did you spend in the past 12 months on food?
The honest answer for most of us, for me, for example, is I'm not sure how much I spent on food last year. I could use a better bookkeeping system.
If I want to start making better decisions, changing my behavior with respect to how much money I'm spending on food, I first have to have a system in place where I keep track of it.
Simply stated, bookkeeping is the preservation of a systematic quantitative record of an activity. And until you have a record of an activity, you really can't make any sophisticated decisions with respect to that activity.
You got to get it written down. You got to get it recorded. Once that happens, then you can start to make more informed decisions.
We can use the past to help us make better decisions for the future, but it starts with getting things written down. That is bookkeeping. Often, the most difficult aspect of accounting is determining which events are to be reflected in the accounting records and which are not. Suppose, for example, that Burger King introduced a new Big Mac clone at half the Big Mac price. The proliferation of these Big Mac clones can have a serious impact on the future of McDonald's. However, events that cannot be reliably measured in monetary terms will not be reflected in the financial statements. Since it would be virtually impossible to quantify the impact of the Big Mac clones on the future profitability of McDonald's, that information will be excluded from the financial statements. While there is an obligation to inform financial statement users about this attack on the Big Mac, the financial statements are not the place to do it. The financial statements are only one part of the information provided to users. Information relating to the competitive environment, product development, and marketing and sales efforts, it's included in the company's annual report to stockholders, but not as part of the accounting information. Now, once we've determined that we have a transaction that needs to be included in the accounting records, the event must be analyzed to determine if an arm's length transaction has occurred. Accounting is concerned primarily with reflecting the effects of transactions between two independent parties. So, Delta Airlines signing a contract with Boeing to purchase airplanes in the future would not be reflected in the financial statements until the airplanes are manufactured and delivered and Delta has agreed to pay for them. While many transactions between independent parties are routine, some business events are quite complex and require a comprehensive analysis to determine how the event should be reflected in the financial statements. Consider the following. A company buys a building. In addition to paying $20,000 in cash, the company agrees to pay $10,000 per year for the next 10 years. The company will also pay a $2,000 property tax bill associated with the building from last year. As part of the purchase, the company gave the former owners of the building 500 shares of stock. Finally, the building will require $23,000 worth of repairs and renovations before it could even be used. Now, how much should be recorded as the cost of the building? Transactions like this can become quite complex, but the framework introduced in this topic will allow you to break complex transactions into manageable pieces and provide you with a self-checking mechanism to ensure that you haven't forgotten anything. Let's begin our analysis of transactions by reviewing some of the basics. First, remember the fundamental accounting equation. Assets must equal liabilities plus owner's equity. That is, a company's resources can be financed using two sources, creditors or owners. As we said previously, the accounting equation must always remain in balance. To see how this balance is maintained when accounting for business transactions, consider the following activities. In the first transaction, $50,000 is invested by owners. This would cause our assets, specifically cash, to increase and our equity, specifically capital stock, to increase, both by $50,000. In the second transaction, we borrow $25,000 from a bank. Again, our assets, cash, increase by $25,000, and our liabilities, since we will have to repay this notes payable, increase by $25,000 as well. Note that so far, our accounting equation balances after each transaction, and in fact, we can always count on that. The accounting equation will always balance. The only instance in which it will not balance is when we've done something wrong. To the third transaction, inventory, that is an item that we will resell later, is purchased on credit. We will pay for our inventory at a later date. Our assets, specifically inventory, increased by $14,000, and our liabilities, specifically accounts payable, increased by $14,000 as well, as we now owe money to a creditor at some point in the future. In the fourth transaction, we purchase equipment by paying cash. In this instance, we are trading one asset, cash, for another asset, equipment. Cash is going down by $15,000, and equipment is going up by a corresponding amount. For each transaction, the accounting equation remains in balance because identical amounts are added to both sides, subtracted from both sides, or added to and subtracted from the same side of the equation. Following each transaction, we can ensure that the accounting equation balances. Note in this spreadsheet how after each transaction, we can track the balance for our assets, our liabilities, and our owner's equity to ensure that the accounting equation balances. After transaction 1, assets equal $50,000 and owner's equity equals $50,000. After transaction number 2, assets now equal $75,000, with liabilities equaling $25,000 and owner's equity equaling $50,000. After transaction 3, where we bought inventory on account, assets equal $89,000, liabilities equal $39,000, and owner's equity still equals $50,000. Finally, after the 4th transaction, where we purchased equipment paying cash, in other words, we traded one asset for another, our accounting equation still balances. Assets equal $89,000, liabilities equal $39,000, and owner's equity equals $50,000. The accounting equation balances. Hold on to that concept. When things get complicated, and they can, knowing that the accounting equation must always balance helps us to determine if we've considered all the effects of a transaction. Instead of using the terms left and right to indicate which side of a T account is affected, terms unique to accounting were developed. Debit, abbreviated DR, is used to indicate the left side of a T account, and credit, abbreviated CR, is used to indicate the right side of a T account. Debit means left, credit means right. Nothing more, nothing less. Let me say that again. Debit means left, and credit means right. Now, in addition to representing the left and right side of an account, the terms debit and credit take on additional meaning when coupled with specific accounts. By convention, for asset accounts, debits refer to increases, and credits refer to decreases. For example, to increase the cash account, we debit it. To decrease the cash account, we credit it. Since we expect the total increases in cash to be greater than the decreases, the cash account will usually have a debit balance after accounting for all transactions. Thus, we can make this generalization. Asset accounts will usually have debit balances. That is, their balance will typically be on the left side of the T account. Now, the opposite relationship is true for liability and owner's equity accounts. They are decreased by debits and increased by credits. As a result, liabilities and owner's equity accounts will typically have credit balances. In addition to assets equaling liabilities and owner's equity, debits should always equal credits. If you fully grasp the meaning of these two equalities, you are well on your way to mastering the mechanics of accounting or learning the language of accounting. Debits and credits allow us to take a shortcut to ensure that the accounting equation always balances. If, for every transaction, debits equal credits, then the accounting equation will always balance. To understand why this is, keep in mind 3 basic facts regarding double entry accounting. First, debits are always added on the left side of an account and credits on the right side. Second, for every transaction, there must be at least one debit and one credit. And third, debits must always equal credits for every transaction. If you can grasp these 3 points, you're well on your way to understanding the mechanics of accounting. Assets equal liabilities plus owner's equity. Debits equal credits. If you hang on to these 2 equalities, all will be well. Let us now see how these 2 equations work together with some examples. Now, notice what these equalities mean for the investment by owners transaction we discussed previously. An asset account cash is debited, it's increased. An owner's equity account capital stock is credited, it's also increased. There is both a debit and a credit for the transaction, and we have increased accounts on both sides of the accounting equation by an equal amount, thus keeping the accounting equation in balance. To make sure you understand the relationship between debits and credits, the various accounts, and the accounting equation, we need to examine further the remaining transactions we've discussed previously. When cash is borrowed from a bank, cash is increased with a debit, and notes payable, a liability, is increased with a credit. When inventory is purchased on account, we have inventory increasing. Since inventory is an asset, the inventory account will increase with a debit. The amount we owe in the future, the liability account, is also increasing. We know that liabilities increase with credits. Now, in the fourth transaction, we purchased equipment paying cash. We are exchanging one asset for another. Assets go up with debits, and they go down with credits. Since we now have more equipment, the equipment account will be debited. And since we have less cash, the cash account is decreased, and we know that cash account will be credited because of the decreased. Note that every time an account is debited, other accounts have to be credited for the same amount. This is a major characteristic of the double entry accounting system. The debits must always equal the credits. This important characteristic creates a practical advantage, the opportunity for self-checking. If debits do not equal credits, an error has been made in analyzing and recording the entity's activities. It is very important to understand the relationship between the various types of accounts and debits and credits. The relationship is detailed in this illustration. Asset accounts increase with debits, and they decrease with credits. Liability and owner's equity accounts increase with credits, and they decrease with debits. At the end of the day, assets typically have debit balances. That is, the amounts being debited are larger than the amounts being credited. Also, liabilities and owner's equity accounts have credit balances. That is, the amounts being credited are larger than the amounts being debited. Now, if this is making your head hurt, don't worry. You're not the first person whose head is hurt studying this material. Think about it. If it were easy, you would have digested this material long ago. This is hard, but you're right on the edge of a major breakthrough. Once we combine debits and credits with journal entries, which are right around the corner, this will begin to clear up. Please don't feel bad when this seems hard. It is hard. That, after all, is why you're watching this course. If it were easy, you wouldn't need this course. Now, please make sure you understand the information contained in this exhibit. Once you understand the relationship of debits and credits to the different types of balance sheet accounts, things start to make a lot more sense, and you begin to understand the power behind this very old, very useful bookkeeping system. Now, at this point, we must bring revenues and expenses into the picture. Obviously, they're going to be a part of every ongoing business. Recall from our discussion of the income statement that resources provide resource inflows. They are increases in resources from the sale of goods or services. Expenses represent resource outflows. They are costs incurred in generating revenues. Note that revenues are not synonymous with cash or other assets, but are a way of describing where the assets came from. For example, cash received from the sale of a product is recorded as the asset cash, but the source of the asset would be considered revenue. In contrast, cash received by borrowing from the bank would not be revenue, but an increase in a liability. By the same token, expenses are a way of describing how an asset has been used. Thus, cash paid for interest on a loan is an expense, but cash paid to buy a building represents the exchange of one asset for another. So, how do revenues and expenses fit into the accounting equation? Remember, revenues minus expenses equals net income, and net income is a major source of change in owner's equity from one accounting period to the next. Revenues and expenses, then, may be thought of as temporary subdivisions of owner's equity. Revenues increase owner's equity, and so, like all other owner's equity accounts, are increased with credits. Expenses reduce owner's equity, and owner's equity is reduced with debits. Let me say that again. Revenues increase owner's equity, and owner's equity increases with credits. Expenses decrease owner's equity, and owner's equity decreases with debits. This is sometimes confusing, so let me be clear. As expenses go up, owner's equity goes down. The more debits to my expenses, the more my owner's equity decreases. Why? Because remember, owner's equity goes down with debits. Now, one other temporary account affects owner's equity. The dividends account shows distributions of earnings to owners. Because dividends reflect payments to the owners, thereby reducing owner's equity, the dividend account is increased with a debit and decreased by a credit. Using the corporate form of business, the accounting equation may be expanded to include revenues and expenses and dividends as shown here. All we're doing with this expansion of the accounting equation is recognizing that when expenses go up, they are, in effect, decreasing the retained earnings account, and retained earnings is decreased with a debit. Dividends have a similar effect on retained earnings. Another way to think about dividends is that they are earnings that are not retained. They are instead returned to the owners of a business. Earnings that are not retained would involve decreasing my retained earnings, and that would require a debit to the retained earnings account. Revenues, on the other hand, effectively increase our retained earnings account, and retained earnings, why, it's increased with a credit. Now, I want to remind you once again that this is hard stuff. Most people pull back at about this point in time, right on the edge of the big breakthrough, and they just don't see it through. Well, that's not going to be you. In the very near future, the dots are going to connect, and you will soon know what many individuals just don't have the discipline to learn. Debits and credits are a new language, and learning a new language requires patience and effort. Hang in there. Your effort now will be so worth it later. Now, some words of caution. First, be careful not to let the general non-accounting meaning of the words credit and debit confuse you. In general conversation, credit has an association with plus and debit with minus. But on the asset side of the accounting equation, where debit means increase and credit means decrease, this association can lead you astray. In accounting, debit simply means left, and credit simply means right. Second, individuals who have trouble grasping debits and credits usually get hung up on the revenue and expense accounts. Remember that revenues and expenses are subcategories of retained earnings. When you credit a revenue account, you are essentially increasing retained earnings. When you debit an expense account, you are increasing the amount of the expense, which in turn reduces retained earnings. Finally, we stated previously that owners' equity accounts will have credit balances. However, expenses, a component of retained earnings, will almost always have a debit balance. Since revenues will usually exceed expenses, the net effect on retained earnings will result in a credit balance. Whew. Now that we understand that the accounting equation must always balance and that debits must always equal credits, we're now ready to try our hand at actually recording transactions like real accountants do.
Let's get an overview of the specific items included in the financial statements. These are the things that are recorded in the books through the debit and credit journal entries.
We record assets. We all have an intuitive sense of what assets are. A formal definition is that assets are resources owned or controlled by a company that will provide probable future benefit.
Okay, let's take the simplest example, cash. For example, if you look at the balance sheet of Apple, you see they've got lots of cash, billions of dollars of cash. This cash is tracked into and out of the company through debit and credit journal entries.
Now let's do a little mental trip into a Walmart location. Close your eyes, drive into the Walmart parking lot, and get out of your car. Now you're walking across the parking lot. You're walking on one of Walmart's assets. The land is a Walmart asset.
You walk into the building. The building is another Walmart asset.
Now stand in the middle of the store and look around at all the stuff on the shelves. That's called inventory, the stuff that you can buy from Walmart. Inventory is an important asset for Walmart.
Land, building, inventory, all these assets are acquired and then sold, and these events are recorded in debit and credit journal entries.
Now, it's true that very few businesses still use paper books with handwritten journal entries.
However, the 500-year-old debit and credit logic still underlies the computer software and enterprise data systems used by all companies.
Now, back to examples. The accounting records also include the liabilities of a company, obligations that will require a future sacrifice, usually by paying cash.
Now, a good example of a liability is accounts payable. For example, when Walmart buys inventory, the company promises its suppliers, Procter & Gamble or Black & Decker or whomever, that they'll pay in the future. That promise is an obligation called accounts payable.
The processes of buying on credit and then later paying these obligations in cash are reflected in the debit and credit journal entries.
Now, most companies also have bank loan liabilities. Both the initial cash inflow from receiving the loans and the cash outflow when the loans are repaid with interest are recorded in debit and credit journal entries.
Now, sometimes owners directly invest new cash into their business. We call this paid in capital, which is the amount that owners take out of their personal savings and pay into the business.
This amount is sometimes called capital stock or capital contributions. The receipt of this cash from owners is recorded in journal entries with debits and credits.
Collections of cash from customers, that's also recorded with debits and credits.
Payments to employees, payments for rent, and payments for electricity are also recorded in journal entries using the same debit and credit system.
Now, what about when a corporation pays dividends to the shareholders? How's that recorded?
Yep, dividend payments are also recorded in journal entries using debits and credits.
In short, every transaction that a business undertakes is analyzed, converted into the debit and credit language, and then recorded in the financial records using journal entries.
Let's get some experience with the debits and credits for a broad sample of business transactions.
With our knowledge of the different types of accounts, assets, liabilities, and owner's equity, and the use of the terms debits and credits, debit means left, credit means right, we are now ready to actually record the effect of transactions. The second step in the accounting cycle is to record the results of transactions in a journal. Journals provide a chronological record of all transactions of a business. They show the dates of the transactions, the amounts involved, and the particular accounts affected by the transactions. Sometimes even a detailed description of the transaction is included. This chronological recording of transactions in a journal provides a company with a complete record of its activities. If amounts were recorded directly in the accounts, it would be difficult, if not impossible, for a company to trace a transaction that occurred, say, 6 months previously. Small companies, such as a locally owned pizza restaurant, may use only one journal, called a general journal, to record all transactions. Larger companies, having thousands of transactions each year, may use special journals. An example of a special journal is a cash receipts journal in addition to using a general journal. A specific format is used to record transactions in a journal entry. The debit entry, always listed first. The credit entry, always listed second. And the credit entry is indented to the right. Normally, the date and a brief explanation of the transaction are considered essential parts of the journal entry, and dollar signs usually omitted. You're 18 again, and you want to work outdoors and set your own schedule. So let's start our own landscaping business. Okay, your first task in starting this business is to acquire cash, either through owner's investment or by borrowing. Now, remember, you're 18 again. You got a full head of hair and a million ideas. You're ready to make some money. You have $1,000 in savings and your parents have offered to match your funds. You decide to issue 200 shares of stock. You make this journal entry. This transaction increases cash as a result of capital stock being issued to investors or stockholders. The cash account is debited because an asset, cash, increased, and the capital stock account is credited. Remember, owner's equity accounts are increased with credits. The economic impact of this situation may be summarized as follows in the accounting equation. Note from the journal entry that our debits equaled our credits, and note from the spreadsheet that our assets equal our liabilities plus our owner's equity. This will always happen if we've done things correctly. Okay, next. Suppose that on top of the money from yourself and your parents, you went to a bank and somehow convinced the loan officer to lend you some money. What were they thinking? You're 18, but hey, you did it. The journal entry for such a transaction would be as follows. Here, the cash account is debited and the notes payable account is credited. Cash is debited because cash is an asset, and assets increase with debits. Notes payable, a liability, is credited because we now owe more money, and increases in liabilities are recorded with credits. A note is a contract specifying amount that one party will repay to another, usually with interest along the way. This particular account could also be called loans payable. The accounting equation captures the economic impact of borrowing the money as follows. We now have assets totaling $4,000 funded with liabilities in the amount of $2,000 and investments by owners also to the tune of $2,000. Again, our accounting equation balances because our debits equaled our credits in our journal entry. Now that you have the funds necessary to start your business, you can use that money to acquire other assets needed to operate the business. You need assets like supplies, inventory, and equipment like a lawnmower and a truck for hauling. These assets may be purchased with cash or on credit. Credit purchases require payment after a period of time, for example, 30 days. Normally, interest expense is incurred when assets are bought on time payment plan that extends beyond 2 or 3 months. We will show how to account for interest in an upcoming section where we discuss the payment of obligations. Now we will demonstrate transactions involving the acquisition of non-cash assets. The first thing you need is a lawnmower and some form of transportation. You can't afford a new car, but you do find a 1998 lime green pickup truck for sale for $800, and you buy it paying cash. With this transaction, you're trading one asset for another. The account truck, an asset, will increase. And we know that assets increase with debits. We also know that our cash, an asset, has decreased, and assets decrease with credits. The impact of this journal entry on our accounting equation looks like this. Note at all times that our assets equal our liabilities plus our owner's equity. The accounting equation always balances because the debits always equal the credits. You're 18 again and you want to work outdoors and set your own schedule. So let's start our own landscaping business. Next, you drive to the local lawn and garden store and purchase a lawnmower and a gas can for $250. Instead of paying for the mower with cash, you open a charge account, which will allow you to pay for the mower in 30 days with no interest charge. Beyond this 30-day grace period, an interest charge is going to apply. The journal entry to record this purchase, shown here. We increase our asset, equipment, and assets, as we know, are increased with debits. We also increase our liability, accounts payable, and we know that liabilities increase with credits. Thus, debits equal credits. And as a result, we know that the accounting equation is going to balance. The accounting equation you can see here. Now, when you eventually pay for the mower, cash will be reduced, and the liability, accounts payable, will also be reduced, thus keeping the equation in balance. Now, back you go to the lawn and garden store to purchase fertilizer, gloves, a rake, shovel, and other assorted supplies. The total cost, $180, which you pay in cash. An increase in one asset, supplies, results in a decrease in another asset, cash. Again, the debits equal the credits. The accounting equation now shows that we have assets totaling $4,250 if we add up all the asset accounts, liabilities of $2,250 if we add up all the liability accounts, and owner's equity of $2,000. The amount of our assets exactly equals the amount of our liabilities and owner's equity. Perfect. Now, on the way home from the store, you drive past a greenhouse and notice a big sign advertising a 50% off sale on shrubs. Since you anticipate that planting shrubs will be part of your business, you stop and you purchase for cash $150 worth of shrubs as inventory. You plan to make money in two ways with the shrubs. First, revenue from the labor associated with planting them. And second, a profit on selling of shrubs for more than you paid. After all, that's fair. You're saving your client the time and trouble of having to go to the greenhouse. The journal entry for recording these transactions is as follows. This journal entry, recognizing that you are again trading one asset for another. You have less cash. That requires a credit to the cash account. And you have more inventory, which, being an asset, increases with the debit. Now, the various account balances that are part of the accounting equation will look like this. Our assets, if we total them up, equal $4,250. Our liabilities total $2,250. And our owner's equity account, capital stock, is $2,000. Our balance sheet, still balances. Now, I've been involved with accounting for almost 40 years, and I am still amazed that the system always works. We just need to remember the following. Debits go on the left side of the T account, credits go on the right. Assets increase with debits, and liabilities and owner's equity accounts increase with credits. There's always one debit and one credit for each transaction for each journal entry, and debits always equal credits. Now that you have your lawnmower, transportation, supplies, and inventory, it's time for you to get to work. The next category of common transactions involves the sales of service or merchandise. You generate revenues and incur expenses during this process. Sometimes you might sell services and merchandise for cash. At other times, you might sell them on credit, and a receivable is established for collection at a later date. Therefore, revenues indicate the source, not only of cash, but of other assets as well, all of which are received in exchange for the merchandise or services provided. Similarly, expenses may be incurred and paid immediately with cash, or they may be incurred on credit. That is, they may be charged with a cash payment to be made at a later date. We will illustrate these possibilities in the transactions that follow. And note that the effect of revenues and expenses on owner's equity is indicated in brackets for each transaction. So, let's get started. As soon as your neighbors find out that you're in the lawn care and landscaping business, your phone begins ringing. Although most of your clients pay you immediately when you perform the service, some prefer to pay you just once a month. As a result, a portion of your revenues is received immediately in cash while the balance becomes a receivable. The journal entry to record your first week's revenue for lawn care services is as follows. A debit to cash, because cash is an asset and assets go up with debits, for $270. And then a debit to accounts receivable, again because accounts receivable is an asset and assets increase with debits, for $80. And then we have a credit to lawn care revenue for $350. Lawn care revenue is a revenue account, which, based on the expanded accounting equation, is part of owner's equity. And we know that owner's equity accounts go up with a credit. As this journal entry illustrates, more than two accounts can be involved in recording a transaction. This type of entry is called a compound journal entry. Because revenues increase with owner's equity, the accounting equation shows an increase in assets and an increase in owner's equity, both increasing by $350. Now, please note that revenue is not an asset. The assets in this transaction are the cash and the accounts receivable. Revenue is the label given to the source of these assets. They were generated in the normal course of business. When assets are received from investment by owners, the source of the asset is capital stock, part of owner's equity, as we showed previously. When assets are borrowed, the source of the asset is a liability. And when assets are generated by providing a good or service, the source of that asset is labeled as revenue. Okay, now one of your customers asks if you'll plant some shrubs in her backyard. She's thrilled that you have just the shrubs that she wants, thereby saving her a trip to the greenhouse. You use 1/2 of your inventory of shrubs in this customer's yard, and it takes you 3 hours to complete the job. She pays you in cash. In this instance, we are dealing with two different types of revenue: profit from the sale of the shrubs and revenue from your labors. Let's deal with each type of revenue separately. First, the sale of the shrubs. Sales, whether made on account or for cash, require entries that reflect not only the sale, but also the cost of the inventory that's sold. The cost of goods sold is an expense, and as such is offset with the sales revenue to determine the profitability of the sales transactions. While accounting for inventory can get quite complicated, for our purposes, we're just trying to illustrate the effects of these transactions on the accounting equation. Now, in this example, you charged your customer $90 for 1/2 of the shrubs you purchased earlier. The journal entries to record this transaction are as follows. Now, in this example, inventory costing you $75 is being sold for $90 in cash. Note that the cash account goes up again. Cash, an asset, goes up with a debit. Sales revenue increases with a credit. Both the debit and the credit are in the amount of $90. Now to the second entry associated with this transaction, the cost of the goods that were sold. What should we call the cost of goods that are sold? Well, accountants tend to call things what they are. The cost of the goods sold is recorded in an account that's called exactly that, cost of goods sold. It's an expense. And we know that expenses decrease owner's equity, and they do that through retained earnings. Cost of goods sold, our expense, is debited for $75. In addition, inventory went down, and inventory, being an asset, goes down with a credit. Debit cost of goods sold, credit inventory for $75. The effect on the accounting equation for each transaction is as follows. With the first journal entry, assets, cash, increase as a result of earning revenue. In the second journal entry, assets, inventory, decrease as a result of using the asset to generate revenues. This is called an expense. The label expenses is used to explain how assets have been used. Sometimes assets are consumed as part of doing business. In this transaction, the shrubs now belong to your customer and they are gone from your business. expense is the label we give to the amount of assets consumed in doing business. Hopefully, the revenues, the amount of assets generated, will be more than the expenses, the amount of assets consumed. Now, in addition to making a profit on the sale of the shrubs, you also generated revenue by planting them. The journal entry to record this revenue is as follows. We work. Someone pays us cash. Cash increases, and cash increases with a debit. And the source of the increased cash is landscaping revenue. And as we know, revenues increase with credits. The effect of this transaction on the accounting equation is that our assets increase by $45 and our owner's equity, through revenues, increase by $45 as well. Thank heavens the accounting equation balances. But we knew it would. Why? Because our debits always equaled our credits. In addition to expenses relating to the sale of inventory, other expenses are also incurred in operating businesses. Examples in our business include gas for the lawnmower and your truck and the wages you agreed to pay for your little brother for working for you. After all, Mom said you had to hire him. The following journal entries illustrate how these expenses would be accounted for. Gasoline expense is a debit for $50, recognizing that owner's equity is decreasing, and cash is credited to show that cash went down. The cash paid for wages is treated the same way, a debit to the expense account and a credit to cash. The effect on the accounting equation of the gasoline expense is that it decreases assets by $50 and decreases by owner's equity by $50 as well. Now, the entry for wage expense affects the equation in the same manner, the only difference being the amount, $60. Obviously, once merchandise or services are sold on account, the receivable must be collected. The cash received is generally used to meet daily operating expenses and to pay other obligations. Excess cash can be reinvested in the business or distributed to the owners as a return on their investment. So now it's the end of the month. Let's go collect some cash. The collection of accounts receivable is an important aspect of most businesses. Receivables are created when you allow certain customers to pay for your services at a later date. When receivables are collected, the asset is reduced and cash is increased, as shown in this journal entry. The asset cash increased, and increased with a debit, of course, and the asset accounts receivable decreases, and that's shown with a credit. Now, the effect of collecting receivables on the accounting equation is this. Now, note that no revenue is involved here. Revenue is recorded when the original sales transaction creates the accounts receivable. The cash collection on account merely involves exchanging one asset for another. Now, remember that lawnmower and gas that you purchased on account? Well, now you have to pay for them. What would the journal entry be to pay off that previously recorded accounts payable? What would that look like? Well, let me think. Cash is being paid. That means cash is going down, and cash being an asset goes down with a credit. So what's the corresponding debit? Well, our liabilities being paid. It is no longer. Liabilities go down with debits. There you go. Sometimes you might sell services and merchandise for cash. At other times, you might sell them on credit, and a receivable is established for collection at a later date. We will illustrate these possibilities in the transactions that follow. And note that the effect of revenues and expenses on owner's equity is indicated in brackets for each transaction. So, let's get started. Now, recall in a previous transaction that we showed the entry required when cash was borrowed from the bank. In that entry, you borrowed $2,000 to be paid over 12 months. Suppose you're required to make a monthly loan payment of $178, with a portion of each payment being attributed to interest and a portion to reducing the liability, just like a mortgage on a house. As the following compound journal entry shows, a note payable or similar obligation requires an entry for payment of the principal as well as the interest due. Note that interest is the amount charged for borrowing money. Analysis of this transaction reveals that the asset, cash in this case, has decreased for two reasons. First, a portion of the liability has been paid with cash, and liabilities, as we know, decrease with debits. Second, interest expense at 12% for 1 month on the note payable has been paid, and expenses are recorded as debits, remember? Expenses reduce owner's equity, and that happens with a debit. Since the interest charge is an expense and decreases owner's equity, the impact of the entry on the accounting equation looks like this. Now, recall that you obtained financing in two ways to start your business: investors, you, mom and dad, and the bank. In the previous journal entry, we illustrated how the bank receives a return on its investment. Well, mom and dad would like a return as well. Corporations that are profitable generally pay dividends to their stockholders. Dividends represent a distribution to the stockholders of a part of the earnings of the company. This is reasonable because the earnings belong to the owners of the company, the stockholders. The following entry illustrates the payment of a cash dividend with a debit to the dividend account and a credit to cash. Now, as noted earlier, dividends, like revenues and expenses, affect owner's equity. But unlike revenues and expenses, dividends are a distribution of profits and therefore are not considered in determining net income. Because dividends reduce the retained earnings accumulated by a corporation, they decrease owner's equity. The payment of a $50 dividend affects the accounting equation as follows. The grand takeaway from this exercise is that because debits equal credits with each and every journal entry, the accounting equation balanced with every transaction. Now that you've seen some examples of journal entries, perhaps you're starting to see a pattern. I want to share with you 3 simple questions you can ask for every transaction. If you get in the habit of asking these 3 questions, the whole debits and credit thing gets a lot easier. 1. What accounts are involved? 2. Did the accounts increase or decrease? And 3. By how much did each account change? The answer to question 1 tells you if the accounts involved are assets, liabilities, or owner's equity accounts. The answer to question 2, considered in conjunction with the answer to question 1, tells you if those accounts are to be debited or credited. Consider the instance where $25,000 is borrowed from a bank. The 2 accounts involved are cash and notes payable. Cash increased, and since cash is an asset and assets increase with debits, then cash must be debited. Notes payable increased. We owe more money, and since notes payable is a liability and liabilities increase with credits, then notes payable must be credited. Now, this 3-step process will always work, even for complex transactions. Consider the case where inventory costing $60,000 is sold on account for $75,000. Using the 3-step process results in the following. Question 1. What accounts are involved? Well, accounts receivable, that's an asset. Inventory, that's also an asset. Cost of goods sold, well, that's an expense, part of owner's equity. And sales revenue, a revenue account, also part of owner's equity. So we've got our 4 accounts. Question 2, did the accounts increase or decrease? Well, accounts receivable went up. Customers owe us more money. Since accounts receivable is an asset, it's increased with a debit. Now, to inventory, that decreased. We don't have it anymore. Since inventory is an asset, it's decreased with a credit. Now our 3rd account, cost of goods sold, that's increased. That's an expense causing owner's equity to go down. Since owner's equity decreases with a debit, cost of goods sold must be debited. Our 4th account, sales revenue, well, sales revenue increased. Remember, our revenue causes owner's equity to go up. Since owner's equity increases with a credit, sales revenue has to be credited. All right, question 3. By how much did each account change? The answer to question 3, combined with 1 and 2, results in the following journal entry. Now, this 3-question process works every single time. You just have to be systematic. The same 3 questions asked consistently for every transaction will always ensure that debits equal credits, and as a result, the accounting equation, Yahoo, always balances.
Remember when we used to work as bookkeepers at Wasatch Medical Center back in the day when we were accounting students at BYU?
Those were the days. That was some real hands-on experience, keeping the books for a partnership of 3 busy doctors.
I started there first, and then you came along a couple of years later after I graduated from BYU. Now, by the time you got there, I had the entire bookkeeping operation working like a well-oiled machine.
Hey, we could conduct an entire course about the messes that you made that I had to clean up. But today, let's focus on the transition from paper-based records to computer-based records at Wasatch Medical Center.
Okay, good. Now, when I started working for the doctors, their books actually were 2 big physical books.
2? Why 2?
Okay, well, one book contained a chronological list of the business events, cash collections from customers and insurance companies, payments to suppliers, payroll, payments for utilities, and so forth. All these events were coded using the awesome accounting debit and credit language.
Well, what was in the other big book?
Okay, well, the other big book was called the Ledger. This book contained a page, or in some cases, several pages, summarizing all of the business events affecting each important financial item in the business.
Yeah, a ledger. So there was a page containing a listing of all the cash collections and payments, and a page listing all the purchases from and payments to suppliers.
Exactly. Now, I created this ledger by laboriously going through each of the events recorded in the chronological journal, sorting them, and then copying them into the correct pages in the ledger. This process is called posting.
Ah, got it. The journal is a chronological listing of business events using the accounting debit and credit language. The ledger is a copy of those same events sorted by category or account, such as cash, supplies, payables to suppliers, and so forth. But these 2 big books weren't there when I took over. What'd you do with them?
Okay, sorry. Not long after I started working for the doctors, they decided to buy a mini computer and some business software.
I remember the computer and the business software. By today's standard, that computer was a large piece of work, about the size of a small desk.
Yeah, and it was expensive. My estimate is that the computer and software cost the equivalent of about $50,000 in today's dollars.
So what problems did you have when you converted the accounting records from the physical books to the computer?
Well, no problems, really. I just had to make sure that everything added up correctly in the physical books before I then transferred the balances into the computer.
Well, that could have been a nightmare. The Partnership of Doctors had been in existence for about 20 years, and those books had been maintained by a series of part-time students during the entire time. Imagine the errors that could have accumulated over 20 years.
Yeah, well, that was when I really saw the power of the simple debit and credit language of accounting. It's a marvelous self-checking system.
So after 20 years, no errors?
No, there was one error for 9 cents.
Over those 20 years, literally millions of dollars in transactions must have passed through those books. Millions.
Yep. But because of the power of the debit and credit system, the error, cumulative error, 20 years, 9 cents.
Well, we need to talk more about this posting process. Once transactions have been analyzed and recorded in a journal, it's necessary to classify and group all similar items. This is accomplished by the bookkeeping procedure of posting all the journal entries to appropriate accounts. That simply means that the numbers from the journal entries must be transferred to the individual accounts. Now, I should note at this point that computers are very, very good at this part of bookkeeping. Computers transfer the right numbers to the right accounts and make sure those numbers get put on the proper side of the account, the debit side or the credit side. As indicated earlier, accounts are records of like items. They show transaction dates, increases and decreases, and balances. For example, all increases and decreases in cash arising from transactions recorded in the journal are accumulated in one account called cash. Similarly, all sales transactions are grouped together in the sales account. Posting is no more than sorting all journal entry amounts by account and copying those amounts to the appropriate account. No analysis is needed. All the necessary analysis is performed when the transaction is first recorded in the journal. All accounts are maintained in an accounting record called a ledger. Here's an example of how the first 3 transactions involving cash in the general journal would be posted to the cash account in the general ledger, with arrows depicting the posting procedures. Observe that a number has been inserted in the posting reference column in both books. This number serves as a cross-reference between the general journal and the accounts in the general ledger. In the journal, it identifies the account to which the journal entry has been posted. In the ledger, it identifies the page on which the entry appears in the general journal. For example, the GJ1 notation in the cash account for the July 1st entry means that the $2,000 has been posted from page 1 of the General Journal. Now, as you might imagine, these posting references are useful in tracking down mistakes. With a computer system, the software automatically generates these posting references. Now, you can see that the cash account is constantly updated as journal entries are posted. The cash account you see here serves the same purpose as the cash column in the spreadsheet that we've been reviewing. All the transactions related to a specific account are accumulated together. Now you can see why a spreadsheet would quickly get unwieldy if we had several hundred accounts. That would be a very big spreadsheet. A particular company will have as many or as few accounts as it needs to provide a reasonable classifications for its transactions. The list of accounts used by a company is known as its chart of accounts. The normal order of a chart of accounts begins with assets, then liabilities, followed by owner's equity, then sales and expenses. Here is one example of some accounts that might appear in a typical company's chart of accounts. Now, for big multinational corporations, the chart of accounts could involve thousands of accounts. Imagine dealing with all those accounts by hand. That would be impossible. Now, at the end of the accounting period, you review the accounts in the general ledger to determine each account's balance. Asset, expense, and dividend accounts normally have debit balances. Liability, owner's equity, and revenue accounts, they normally have credit balances. In other words, the balance is normally on the side that increases the account. To illustrate how to determine an account balance, consider the following T account depicting all the cash transactions from our landscaping business, and we've added dates. The beginning cash account balance plus cash debit entries less total credit entries equals the ending balance in the cash account. In this instance, the cash balance at the end of the period is $2,767. Cash was increased during the period by $4,485 and decreased during the period with credits totaling $1,718. Our cash inflows exceeded our cash outflows. That is good news.
All right, let's imagine that we want to buy this building and convert it into a large ice cream production facility. Now, how much do you think it would cost to get our ice cream business up and running?
Well, if we want to do this right, buying the land, building equipment, and initial stock of raw materials, that's going to cost us about $100 million.
See, I can see it in my mind's eye. The gleaming stainless steel mixing vats, the happy employees wearing white clothes, white shoes, white caps to emphasize the cleanliness of the facility. The huge freezer storage room stacked with delicious ice cream.
Yeah, that's a great vision, but back to reality. Where would we get $100 million in financing to make this happen?
If we want to buy $100 million in ice cream production assets, then we need $100 million in money from somewhere to buy them.
The reality is that if we want to go from small-sized business people to medium-sized business people with assets of $100 million, we're almost certainly going to have to raise a lot of financing from strangers.
Wait, strangers?
Yep, strangers, a bank or a group of banks, venture capitalists who are freelance investors willing to take a risk on a growing business in exchange for part ownership.
Well, we might even consider going public. To go public in the United States, you must file a business plan called a prospectus with the Securities and Exchange Commission, the SEC.
That's correct. Once approved by the SEC, you can issue ownership shares to anyone in the world. In essence, anyone in the world can now become your business partner by buying shares in your corporation.
Now, corporation is merely a collection of hundreds, thousands, or millions of individuals who each own a portion of the company.
Well, that brings us back to financial records. We must provide potential investors, most of them complete strangers to us, with summary financial statements to give them a concrete idea of what they would be investing in if they invested in our ice cream company.
Right. The key point here is that new businesses cannot get financing in a reasonable way without financial statements. In short, financial statements are essential to the functioning of our modern economy, in which we don't raise capital from friends and family, but instead we are typically raising it from strangers.
Reliable financial reports are what make it possible to turn the dreams of entrepreneurs into the reality of actual businesses.
See, I like that. Financial reports turn dreams into reality.
So bookkeeping is not just an amusing exercise in encoding business transactions into debit and credit language.
No. Bookkeeping leads to financial statements, which make it possible for entrepreneurs to convince strangers to provide the financing to turn their entrepreneurial dreams into reality.
Okay, a simple illustration will help reinforce what you've learned about the relationship of assets, liabilities, owner's equity, revenues, expenses, and dividends, as well as the mechanics of the double entry accounting system. Catherine Kohler established the Double K Corporation in 2012. The journal entries to record the transactions of Double K Corporation are shown in the next section. Note here that we've used letters in place of dates. Now, let's quickly walk through each of these journal entries and see if we can tell what they mean. For entry A, cash is being increased. Well, we know what that means because it's being debited. And capital stock and equity account is being increased as well. It looks like capital stock was issued in exchange for $20,000. For entry B, inventory is being debited. Since inventory is an asset and assets increase with debits, we must have purchased inventory. And since cash, another asset, is being credited, that means we must have paid for cash with that inventory. We know we paid cash because assets go down with credits, and cash is an asset. For entry C, cash is increasing. We know that because an asset increases with a debit. Now, how did we generate that cash? Well, a liability, notes payable. Notes payable is being credited here, and we know that liabilities increase with credits. That must mean that we borrowed money and that we will have to someday pay it back, hence the term liability. Now to entry D, we have an asset, land, increasing and an asset, cash, decreasing. It looks like we were trading one asset for another. We debited land for $25,000 and we credited cash for $25,000. Now, entry E actually involves two journal entries. We are selling inventory costing $2,000 for $3,200. That $3,200 will be collected in the future. First, we record the increase in the accounts receivable as a result of the sale. Assets and accounts receivable increase with debits. We debit the accounts receivable account and we credit the sales revenue account. We remember that sales revenue is a sub-account of retained earnings, and retained earnings increases with credits. Now, the second journal entry associated with the transaction, E, records the reduction in our inventory, an asset, because the inventory was sold. We debit the expense account, cost of goods sold, to recognize the expense, and we credit inventory to recognize the decrease in our inventory account. Now, entry F simply is recognizing that the company spent cash and incurred two different types of expenses, selling expenses and miscellaneous expenses. Expenses are reductions in the retained earnings account, and retained earnings goes down with debits. Our cash account goes down with the credit. Now, finally, with entry G, we are collecting cash from those individuals to whom we sold inventory in transaction E. Those customers owed us $3,200, and the $3,200 was originally recorded as an accounts receivable with a debit. Those folks are now paying us. In other words, once they make the payment, they don't owe us anymore. The accounts receivable account must be reduced, and it is reduced with a credit. Cash is then debited. We are trading one asset for another with this journal entry. Hopefully, you're starting to understand how to read a journal entry. With a little practice, you can see a journal entry and figure out what the transaction was. And then you can see a transaction and figure out what the journal entry should be. Now, like all new skills, it takes practice, but hopefully you're starting to get comfortable with the debits and the credits of the accounting system. Just hang in there. Now that we understand the journal entries, the next step is that those journal entries need to be posted to their related accounts. T accounts are used to illustrate this process with the letters A through G showing the cross-references to the journal entries. A balance is showed for the end of the period. Turns out where only one transaction is involved, the amount of the transaction is also the account balance. Let's take a detailed look at the cash T account. What can we surmise just by looking at this account? First, what do we know? Well, for the cash account, it being an asset, we know that debits mean increase and credits mean decrease. We can tell by looking at this account that 3 transactions A, C, and G, caused cash to increase. And we know that 3 transactions B, D, and F, caused cash to decrease. We also know that the ending balance in the cash account is $7,900. We could do a similar analysis for each account. By knowing if the account is an asset, a liability, or an equity account, we know which side of the account reflects increases and which side reflects decreases. And we will also know which side will typically carry the balance. For assets and expenses, those accounts typically have debit balances. For liabilities, capital stock, and revenue accounts, those accounts typically have credit balances. Now, the effect of all these transactions can be visualized using a spreadsheet format as seen here. Note that the balances are exactly the same, whether using a T account or using the spreadsheet. If we were to take a moment and add up all the account balances, we would find that our asset accounts total $40,900. Our liability accounts total $20,000. And our owner's equity accounts total $20,900. Good news, the accounting equation, still balances. Now, after the account balances have been determined, a trial balance is usually prepared. A trial balance simply lists each account with its debit or credit balance as shown here. Remember that an accountant named this report, so its title pretty much describes what the report is. A trial balance simply says, let's do a trial and see if things balance. Let's see if our debits equal our credits. By adding all the debit balances and all the credit balances, the accountant can see whether total debits equal total credits. Now, even if the trial balance does show debits equaling credits, there may be errors. A transaction may have been omitted completely, or it may have been recorded incorrectly or posted to the wrong account. These types of errors will not be discovered by preparing a trial balance. That would require additional analysis. But in this case, total debits equal total credits. Thus, the accounting equation, it balances. The trial balance contains all of our accounts. Those accounts contain the results of all of our transactions. The trial balance contains all of our revenue and expense accounts. Those will go on the income statement. And it contains our asset accounts, our liability accounts, and our owner's equity accounts. Those will go on the balance sheet. From the data in the trial balance, an income statement can be prepared. The income statement shows our revenues less our expenses. In this case, Double K had revenues of $3,200 and total expenses of $2,300, giving us a reported net income of $900. Well, as you can see, an income statement in and of itself is not hard to prepare. You simply pull the relevant accounts from the trial balance. The hard part, as we now know, is analyzing transactions, deciding which accounts are involved, whether those accounts increased or decreased, and by how much. The ease of preparing an income statement is your reward for the hard work put into carefully making and posting journal entries. Now, a balance sheet can also be prepared for Double K Corporation. Notice that there is no retained earnings account in the trial balance, but there is one on the balance sheet. The reason for this is that all the income statement accounts, such as revenues, cost of goods sold, and expenses, are eventually accumulated under retained earnings. Of the earnings reflected on the income statement, the business then decides the amount of those earnings to be retained. Those earnings that are to be retained are disclosed on the balance sheet in retained earnings. Now, a word of caution. Individuals frequently mistake a trial balance and the balance sheet for one another. In fact, they're very different reports. A trial balance is strictly an internal document used to summarize all of the account balances in a company's accounting system. Few people outside a company's accounting department ever see the trial balance. The balance sheet, on the other hand, is a more formal summary document that is frequently provided to interested parties both inside and outside the company. Well, what about the statement of cash flows? Where does that come from? The statement of cash flows can be prepared by categorizing the items in a cash account as operating, investing, or financing as shown here. The inflows and outflows of cash are grouped into the 3 categories of operating activities, things that happen every day, investing activities, transactions that affect the productive capacity of a business, and financing activities, activities that involve debt and capital stock. Now, is real life harder than this? Is this systematic method of analyzing/recording transactions actually what's done in the real world? Yep. You may not believe it, but you now know something that a lot of people don't know. You are becoming fluent in the language of business. You are starting to understand debits and credits. You can analyze transactions and see how they would be quantified into a journal entry. You know how those transactions get put into the accounting system with journal entries. You know that those journal entries are then posted to the various accounts. You know that the financial statements are constructed from the numbers found in those accounts. You know where the numbers on the financial statements come from. It turns out that you now know things most people don't know. Congratulations. Your market value has gone up. Job very well done. Okay, bookkeeping is fun. Debits and credits, they're the best. Transaction analysis and posting are the height of entertainment. And all of this leads eventually to the financial statements. But really, who uses the financial statements?
Who? Everyone does, or at least everyone who wants to be informed. Key users of financial statements are lenders and investors, the people who provide the capital to a business so that an entrepreneur can turn her or his dreams into reality.
But lenders and investors aren't the only external users of financial statements. For example, suppliers use a company's financial statements. If I'm going to sell to you on credit, then I want to know if you're going to be able to pay me.
So if you're considering entering into a long-term, significant supplier relationship where you're going to be selling on credit to another company, first thing you're going to do is get their financial statements, do a little analysis to see if they're going to be able to pay you back.
Customers also use a company's financial statements. Anybody who enters into a long-term relationship with a business wants to know if that business is going to be around in the future.
Employees should also look at a company's financial statements. Employees have long-term relationships with companies.
Before leaving one job and taking another job with a different company, employees should look at the financial reports of the new company.
Is this a strong company? Do they have a strong track record? Can I count on them? Are they going to be here in the long term? Are they financially viable?
Now, competitors also use a company's financial statements. Do you think Coke wants to see the financial accounting reports of Pepsi? Of course they do. Do you think Walmart wants to see the financial accounting reports of Target? Competitors can use a company's financial statements to see its strengths and its weaknesses.
Government agencies are also users of financial accounting reports. Banks, insurance companies, public utilities are regulated by the government. Accordingly, companies in these industries must provide financial accounting reports to the relevant government agencies.
Politicians and their staff also look at financial accounting reports. For example, if I, as a politician, want to make a political argument against, say, high profits in the oil and gas industry, I pull out Exhibit A, their financial reports.
Or if I'm a politician who wants to protect, say, the textile industry in my state, I pull out the financial reports of some major textile businesses to show that their profits are going down.
Now, news reporters also use financial accounting reports. A basic use is to provide simple background information. For example, if I'm writing a story about Apple, I use the company's financial statements to be able to tell my readers about the company's net income, assets, and amount of income taxes paid.
News reporters also use financial reports to trigger investigations. Let's say that a company just announced that their profits have gone down by 70%. That financial accounting report could trigger an investigation by an enterprising reporter who would say, well, why did their profits go down by 70%?
Turns out lots of people use financial statements. Investors, lenders, suppliers, customers, employees, competitors, government agencies, politicians, and news reporters.
And from now on, hopefully you will be in the set of people who are comfortable using the financial statements that are created through a company's bookkeeping process.
Individuals often ask, do I really need to know the difference between a debit and a credit? Haven't computers kind of taken care of all that? Well, computers have greatly facilitated a business's ability to quickly process huge amounts of information without making mathematical errors. Most computers can make millions of calculations per second and produce more documents in 10 minutes than a person could do in an entire week. The time spent posting and journalizing entries and summarizing accounts into a trial balance has been greatly reduced as a result of computers. But Computers still can't think. That, it turns out, that's your job. Walk up to a computer terminal and show it a sales invoice, and the computer will just sit there and wait. Wait for what? For the answer to 3 questions. What accounts are involved? Did the accounts increase or decrease? And by how much did each account change? Let's consider how one of the best-selling money management software packages, Quicken, has changed the accounting process. Quicken, it turns out, works a lot like a check register. For each check, you indicate the date, the check number, the payee, and the amount. Quicken then prompts you to indicate the nature of the expenditure by selecting from a list of accounts. For example, if your expenditure relates to your purchase of groceries, you would select the account Food. Thus, all your transactions relating to food would be grouped together, allowing you to quickly determine all food expenditures. Now, let's review what Quicken has done. First, since you indicated the transaction involved a check, Quicken knows that cash decreased. Quicken is programmed to know that when cash decreases, it involves a credit to the cash account. Quicken also has been programmed to know that debits have to equal credits, and since cash was credited, the program knows that something else was debited. Since you indicated food and expense was the other account, Quicken debits that account, causing your expense account to increase. Now, instead of telling Quicken which accounts to debit and credit, you're required to identify the accounts, that's question 1, and indicate if they increased or decreased, that's question 2. Quicken is able to determine, based on the answer to these 2 questions, which accounts were debited and which accounts were credited. So, has Quicken fundamentally changed the accounting process? No. It's increased the accuracy and speed with which the posting process is done, as well as the speed with which a variety of reports can be prepared. Quicken has also eliminated the need for the user to specify debit or credit. Because computers are so fast, the 2-step process of identifying accounts and the direction of their change can be done as quickly as you can say credit cash. So, why don't accountants get rid of these 500-year-old terms, debit and credit? The reason is that all accountants are familiar with and comfortable using these terms. When someone says credit cash, accountants everywhere know exactly what that means. Thus, debit and credit provide a useful shorthand method of communication. Now, the computer has also enhanced step 3 of the accounting cycle, summarizing. In fact, only in the smallest of businesses will you find the posting of journal entries and the preparation of a trial balance being done by hand. But in every business, from the largest to the smallest, you will find accountants still actively involved in analyzing transactions and turning those transactions into journal entries. And eventually, they get turned into useful accounting reports. Whew, you made it. That may not have been the easiest thing you've ever done, but by golly, you made it. Feel good about that. Now, you may not feel 100% confident that you've mastered all the intricacies of debits and credits, but you're off to a good start. It's true that you're probably not as comfortable as I am with the topic, but keep in mind that I've been at this for 3.5 decades. You've just started. But hey, you started. Let's review what we now know. First, the accounting equation. Assets equal liabilities plus owner's equity. That must always balance. Always. Second, debit means left and credit means right. That's all. Debit left, credit right. Third, assets go up with debits and down with credits. For liabilities and owner's equity accounts, it's exactly the opposite. They go up with credits and down with debits. Fourth, journal entries are the building blocks of financial statements. Fifth, with each journal entry, debits must always equal credits. Always. And sixth, every journal entry requires the answer to 3 questions. What accounts? Did the accounts increase or decrease? And by how much did each account change? Financial statements are just your reward for getting these things right. Turns out financial statements don't just fall out of the sky. They're not a figment of someone's imagination. Financial statements follow directly from journal entries. You get the journal entries right, the financial statements follow. So, what now? Well, first, take a well-deserved rest. You've earned it. Okay, your break's over. Now that you know how financial statements are created, you might want to know how they're commonly used. My brother and I have developed a course called Understanding Financial Ratios that you might consider. In that course, we discussed common techniques for analyzing financial statements and using the results of that analysis to make decisions. So what else can you do? Well, be prepared to see things differently. Now when you go to the grocery store, you will think in your mind as you walk out, debit food, credit cash. When you go to the movies, you will think debit entertainment, credit cash. When you get paid, debit cash, credit revenue. You will begin to see how little transactions become part of the bigger financial picture. Hey, you've seen behind the accounting curtain. You know what goes on back there. It's no longer a mystery. Welcome to the club.